So far, we've issued bonds and recorded the cost of using them during the borrowing period. Now let's see what happens at the end of their life. Bonds are eventually retired. This can be through paying off the principal at maturity or through calling the bonds in before maturity. In other words, paying them off early. Bonds may also be retired early if there is a conversion feature that allows the bonds to be retired in exchange for stock. When bonds are paid off at maturity, the carrying value of the bond will equal the par value, and the journal entry to record the transaction simply involves a debit to bonds payable to clear the liability off the books and a credit to cash. Any discount or premium will have been fully amortized by maturity, so those accounts will already be cleaned up if they existed during the life of the bond. Companies sometimes wish to retire some or all of their bonds prior to maturity. Most of the time, this results in a gain or a loss depending on what the price of the bond is at the time it is called. Called means paid off. Two common ways to retire bonds before maturity are through the exercise of a callable option or through repurchasing them on the open market. These types of early retirements usually result in gains or losses that require additional calculations and journal entries. If a bond is retired at maturity, on the maturity date, the issuing company will write checks to the bondholders to pay off the bonds. To record the payments, the company zeroes out the liability balance by debiting bonds payable. And of course, they record the payment with a credit to cash. The entry is made for the par value of the bond. Remember, at maturity, par value will equal carrying value. If bonds are retired before the maturity date, it is highly unlikely that the par value will be paid. And there are a number of reasons for this that are covered in your text. In any event, a gain or a loss is recorded. The gain or loss is determined by comparing the carrying value of the bond at the retirement date with the cash price paid to retire the bonds. Carrying value is the bond payable balance plus any unamortized premium balance or less any unamortized discount balance on the books at the time of the retirement. Now, before we wrap up, let's take a look at the debt-to-equity ratio. Besides evaluating the different characteristics of debt, investors want to know how much debt a company has, especially in relation to total equity. Such knowledge helps them assess the risk of a company's financing structure. As is true in our personal lives, a company financed mainly with debt is more risky because liabilities must be repaid, usually with periodic interest, whereas equity financing does not. A measure to assess the risk of a company's financing structure, then, is the debt-to-equity ratio. It says exactly what it means, the debt-to-equity ratio. We calculate the ratio by dividing total liabilities by total equity, and this is a very easy ratio to remember because its name tells us how to compute it. The debt-to-equity ratio varies across companies and industries. Industries that have less predictable earnings trends and more volatility tend to have lower ratios, while more stable industries tend to have higher ratios. So that's it for long-term liabilities. I hope this chapter was interesting and practical for you as a potential investor and a business person. Investing is a topic that many students can relate to, even though we just considered it from the borrower's perspective. In the next chapter, we will learn more about another way that companies obtain cash, that is, through equity financing. See you soon.